Hello, my name is Novel Kesi. Today I'm going to give a presentation about my assignment. Okay, auditing. Auditing is the process of examining and evaluating an organization's financial statements, operation, and internal controls to ensure accuracy, transparency, and compliance with relevant laws and regulations. It is typically carried out by an independent auditor who reviews the financial records and practices to verify that they reflect a true and fair view of the organizational financial positions. The main purpose of auditing are assurance of accuracy. Audits provide confidence to stakeholders such as investors, creditors, and regulators that the financial statements are free from material misstatement and accurately represent the organizational financial health. Compliance. Auditing ensures that the organization is following relevant laws, regulation, and accounting standards, reducing the risk of legal or regulatory penalties. Internal control. Evaluating auditing help assess the effectiveness of an organizational internal control, which protect assets, ensure operational efficiency, and prevent fraud. Risk management. Auditing identifies potential areas of risk, helping organizations to mitigate issues before they become major problems. Ultimately, auditing helps maintain trust and integrity in financial reporting, supports informed decision making, and enhances organizational accountability. Thank you. Advantages of auditing: enhance accuracy and reliability. Auditing ensures the financial statements are accurate and compliant with accounting standards that gives stakeholders confidence in the financial health of an organization. Second, fraud detection and prevention. By synthesizing financial records and internal controls, auditors can detect fraud, errors, or financial misstatement. This results is a deterrent against fraudulent activity. Improve credibility. An independent audit adds credibility to financial statement, which is crucial for investors, creditors, and regulators who rely on accurate information to make decisions. Risk management. Audits help identify potential risk in operations or financial statements. By spotting this risk, business can take protective steps to mitigate them. Regulatory compliance. Audits ensures that the company complies with tax laws, industry regulations, and other requirements, reducing the risk of penalties or legal issues. Operational improvements. Auditors often offers recommendation on improving internal controls and business processes, helping the company operate more efficiently. Case study: Enron scandal 2001. Now let's look at significant case study. The Enron scandal background. Enron was once one of the largest energy companies in the US. However, it was revealed that Enron's management used conservative accounting techniques to hide debt and inflate profits. This ultimately led to the company's collapse in 2001. Uh, Audit failure. Enroll's external auditor failed to detect these fraudulent activities despite clear red flags. Anderson issued a clean audit opinion and Anderson's financial statement. Impact. The scandal led to Enroll's bankrupt, causing significant losses for investors and employees. The firm author Anderson was also impacted by eventually collapse due to its role to the frauds. Disadvantages of auditing: a costly process. Audits can be expensive. Hiring external auditors, especially for large organizations, requires significant financial resources. This can be burden, particularly for small businesses. Time consuming. Auditing is often a lengthy process, requires sustainable time and effort. Limited scope. Audits provide a snapshot of a company financial situation at a given time. Dependence on management corporation. Auditors rely heavily on information provided by companies' management and internal system. Risk of over reliance. Stakeholders may place too much confidence in audited financial statements. While audits provide reasonable assurance, they are not foolproof. and may fail to detect every potential problem. Possible conflicts of interest. In some cases, auditors may face conflicts of interest, especially if they have close relationship with the company or provided other services like consulting, which can impair their independence and objectives. Objectives. Case study: the 2008 financial crisis. uh, Latham Brothers. Let's now examine the case study where auditing shortcoming played a role in a major financial disaster, the Lehman Brothers collapse in 2008. Background: Lehman Brothers, once the fourth largest investment bank in the US, declared bankrupted in September 2008, contributing to the global financial crisis. The company used questionable accounting practices such as Repo 105 transactions to hide debt and overstate in its financial health. Auditing. Lehman's internal auditors Young failed to detect or report these um, irregularities. Auditors impact: when Lehman Brothers filed for bankrupted, it is triggered a domino effect in global markets. Uh, Conclusion: while auditing plays a crucial role in ensuring transparency and accountability, it is not without its challenge. The case study of Lehman Brothers demonstrate the how auditing failures were due to the lack of skepticism. Thank you. Okay, so now assurance in auditing. In auditing, assurance refers to the level of confidence or certainty that an auditor provides regarding the accuracy, fairness, and reliability of a company's financial statement or other financial information. The goal of an audit is to provide an independent assessment of whether the financial statement present a true or fair view in accordance with the relevant accounting standard. There are different types of assurance. Reasonable assurance and limited assurance. Today I'll be discuss reasonable assurance and limited assurance. This reasonable assurance, this is the highest level of assurance provided in an audit. It means the auditor has gathered sufficient and appropriate evidence to conclude the financial statement uh, are free from material misstatement, whether due to fraud or error, while reasonable assurance reduces audit risks to low level. It does not guarantee absolutely accuracy. Uh, Limited accuracy. This is a low level of accuracy often associated with review other than full audits. In the case, the auditor provides a conclusion based on limited procedure, which is less thorough than a full audit. Eligibility and regulatory requirements. To ensure compliance with ethical and legal standards, they must be registered with reputable professional associations such as the Institute of Chartered Accountants in England and Wales (ICAEW), or the Association of Chartered Certified Accountants, American Bar Association, Horns of Regrets, and Central Professional Responsibility, American Bar Association in 2017. International standards on auditing (ISA) must be followed by the auditing regulatory environment in order to guarantee uniform and superior standards, including independence, honesty, and neutrality frameworks created by the international international independence, honesty, and neutrality frameworks. Created bodies regulate professional ethics, guaranteeing that the auditors act responsibly and professionally while protecting stakeholders' interests and ethical duties. An auditor's principal duty is to evaluate financial accounts for accuracy and fairness. Auditors must be adhere to ISSA requirements, demonstrate independence, and maintain confidentiality to deliver an honest assessment. Individually avoid companies with direct professional to functions as an auditor. You must be a member of recognized supervisory body. RSP such as SCA and meet the rules auditors can.